everyone, it's James at Yoreevo, New York's #1 commission rebate brokerage, with our September Manhattan market update. And there's one big problem in the housing market right now, both New York City and nationally, and that's mortgage rates. We're going to get to that in a second, but first, just stopping on demand for September. We're seeing similar demand trends as we saw in August, down about 30%. Nothing really interesting here. The impact on higher mortgage rates is going to impact demand going forward. When we look at price points, this is just kind of noise. If you remember last month, we were looking at the higher end, which saw a big decline, but that was more of a function of tough comparisons. That narrowed. Now 1 to 2 million is down 40%. So this is all just kind of noise for the moment. On the inventory side, I don't have good news for sellers there either. While it was very modest, we did see the first increase in supply year over year. So we're up just 1%. It was going to happen eventually, but you can see the gap between the blue line last year and the pink line this year has been narrowing all year, and then finally we eked out a supply increase this month. If we compare September to August, because remember last month we were looking at this increase that happens every post-Labor Day, that was basically in line with what you would normally expect to see in September, slightly stronger, but basically what you would expect to see for September, so no real surprises there. And again, when we break it down by price point, nothing too interesting. But the big story is mortgage rates. This is the chart we've been looking at for the last couple months, and you can see mortgage rates basically just took off over the last 2 months. The Fed did increase mortgage rates, the Fed funds rate by 75 basis points last week. And that did coincide with an increase in mortgage rates. But remember, it's not the increase from the Fed itself that increases mortgage rates. It's what the market thinks the Fed is going to do with that Fed rate going forward that impacts mortgage rates. So we'll leave that aside for the moment. But the takeaway is we're at about 6.7% national average 30-year fixed rate mortgage this week versus about 3% for the beginning of this year and basically all of last year. So the three main problems we're going to have in the real estate market going forward is obviously affordability. When you look at the mortgage payment, comparing a 3% mortgage to a 6.7% mortgage, that's about a 50% increase in the mortgage payment itself. So just strictly from the amount of the purchase prices that buyers can afford now, it's much lower than it was earlier in the year. We are also going to have a problem with supply because a lot of sellers are going to ride it out in their existing properties because they have a much lower mortgage rate. So think about if you bought a 1-bedroom 5 years ago and you were planning to upgrade to a 2-bedroom. Well, now on top of a 2-bedroom being much more expensive than a 1-bedroom, you're also giving up your 3% mortgage or thereabouts on your current place, and you would be taking out a 6.7% mortgage rate on your purchase. So just stomaching that difference in rates is going to be difficult for a lot of sellers, and they're probably going to squeeze out another year or two in their current property, and we're going to see that reflected in inventory levels and transaction count going forward. And then we also have a problem with co-ops specifically because unlike condos where there's usually a lot of breathing room between where buyers' debt-to-income ratios are versus what the bank will allow, the max that the bank will allow, co-op buyers tend to go right up to that line that most co-ops will allow, either 25 or 30%. So as mortgage rates push up, that pushes up the mortgage payment, their total monthly payment, and therefore their debt-to-income ratio. So a lot of buyers, a lot of would-be co-op buyers are just getting squeezed out of the buyer pool because they can no longer qualify for co-ops. They will not be approved. They won't meet the co-op's financial requirements. So we could see a disproportionate impact on co-ops just because the buyer pool is going to dry up more quickly than that on condos. So I should mention that these are national numbers. We haven't seen anybody actually getting quoted a 6% plus mortgage rate. Maybe that's just a lag because obviously they've been going up every week. But we have heard some buyers still getting mortgage quotes very recently under 5%. So reach out to us if you're in the market. We have we're aware of some banks that are just a little more aggressive than others. So you're not going to get 3% anymore, but if you can get under 5%, that's still a great mortgage rate in this market and obviously makes that affordability much more palatable. And of course, if you want to dive into the data, we're happy to slice and dice the data however you like. We're happy to work with you on your search. And of course, we're happy to get you a commission rebate. So you can email us at info@yoreevo.com. And thanks for watching, and we'll see you next month. Bye.